Okay, if you look at the share price, right, year to date up 194%. So this is one of the top performing stocks this year. The momentum is still very strong. If you look at the revenues, right, they just released Q3 earnings, 35 billion of revenue in just one quarter. You can see that since July 2023, like Q3 last year, right, there's this upward trajectory in terms of their revenue. It's like going to the moon. It's a lot higher compared to the previous period. The previous period was, they're lingering up between 5 to 10 billion. Now suddenly shoot up to 35. If you look at their last 12 months, now their annual revenue run rate is already, last 12 months is 113 billion. But let's say if you just multiply by 4 of this quarterly revenue, right, they are now already 140 billions. So quite a sizable numbers. But of course, it's still not close to the top company system in terms of the revenue. But in terms of earnings, they're quite high already in terms of their ranking. So if you look at their growth, right, for this recent quarter, it's 93%. What it means that it almost double as compared to the quarter 1 year ago. But you can see that now because the base, right, is already getting larger. So definitely there will be some slowdown in terms of the percentage growth. Just 3 quarters ago, they are growing like 260%. It's crazy growth, right? Now because it's already on, like you are comparing against a larger base, so 93%. But still, this is like huge number of growth, right? Because I mentioned before, as long as the companies can grow at 15, 20, 25%, those are considered high growth companies. Below 10%, I will say that it's not a high growth, but 93% is a rocketing kind of growth. So this is compared to 1 quarter ago. And if you look at the profit margin, right, although like I said, 35 billions, if you compare to other companies, it's not like super big. But if you look at the margins, right, gross profit margin is at 74%. Of course, this quarter is slightly lower. Management actually guided for the gross margin to be slightly above 70%. But after they start to ramp up Blackwell, which is their latest product, right, their data center chip, once that one ramp up, they still target something around mid 70%. So about 75%. So gross margin wise is super impressive. Then if you look at their net margins, again, this is very impressive. Imagine that $100 of revenue that flow in, right, $55 actually flow to their net income. So net income, you actually after minus out all the expenses, right, so it comes to 55%. So that's why if you rank by their net income, right, they're actually one of the biggest in the world. Later I will have a ranking to show you. So again, if you have a big net income, right, operating income was also 22 billions in just 1 quarter. It was 2 billion, about 1 year ago. Now it's like 22 billions, literally 10x in terms of their operating income. Very impressive. Then when it comes to free cash flow, close to 17 billion in just 1 quarter. And if you look at last 12 months, right, this company is generating 56 billion of free cash flow just in 1 year. So if you rank by free cash flow, I think it's also one of the highest one, because their product is so, the customer demand is so high that they can charge a high price. So if you can charge a high price, the margin is high, the free cash flow is high. And this company, it is a semicon companies, they don't invest heavily into the machinery because they are actually getting other, like for example, TSMC to fab for their chips. So they are, I would consider quite a, capital light business. So that's why they are able to generate this kind of free cash flow. So 56 billion. Next one, diluted net income or earnings, about close to 20 billion or 19 billion in 1 quarter. And rolling 12 months is like 63 billions. So you just look at all this chart, right? You don't have to remember all these numbers. What you need to see is just that some people, they just look at the share price without looking at the fundamentals. I usually will look at the numbers because I think it's important. But sometimes numbers, right, is not easy to give you an, like understanding in terms of how big it is, how big is the growth and so on. But if you just look at the chart, right, you can see that since ChatGPT launched, right, and companies actually ramp up their capex to buy all these GPU chips, setting up data center. So we are talking hundred thousands of chips in one deal, right? So they're selling a lot of all these chips to the hyperscaler and so on. Just look at the pattern. You can see that they are still ramping very fast. Still, like, there's huge demand. And when the management talk about the supply and demand for 2025, they still comment that the demand is still higher than supply. Means that these numbers, right, will still continue to go up, at least for 2025. But after that, very hard to see past, like, let's say 1 year. So that's the caveat. But you look at the trajectory, is still like high growing. That's why when I invest in this company, right, once it breached the all-time high, right, I am not selling, because why would you sell a company just because, let's say, like the share price went up by 30-50%, right? Because if you look at the fundamentals, the revenue, the income, the free cash flow, everything just go up and still continue to do so. We don't know where's the peak in terms of their fundamentals here, right? So better just stay invested, follow their all these fundamentals and see what kind of, you know, revenue that they are able to generate in next few quarters. So just continue to follow. And this is the table that I was mentioning. So this is not comparing the market cap. It's specifically looking at the earnings or the net income. So you look at Nvidia, right? It's currently 61 billion, but this is the last 12-month figures. If you look at, let's say the latest quarter, just multiply by 4, right? I think latest quarter is this number here, multiplied by 4 is already close to 80 billions. So if we're talking about 80 billions, right, it's already higher than JP Morgan. So it's about like, you know, top 6 in the world. So I think that's why I say if they can continue this kind of growth for, let's say, until 2025 and onwards, right, they can even be higher than Microsoft or Alphabet or even Apple, become the top company in terms of net income. So I wouldn't be surprised to see that. But again, all these things, right, we also don't want to speculate and don't want to, you know, extrapolate too much. Just looking at one quarter after another, just follow the fundamentals. I think that's the sensible things to do. Okay, now we are talking about all these fundamentals, all looks good, right? And you can ask people, why don't you invest in Nvidia? I think the most common answer is that the company is very, very expensive. But most people, when they say company is expensive, they are comparing their share price, let's say 1 year ago. So the share price already rocketed up close to 200%, so it is expensive. But if you look at the PE, right, and here specifically I'm looking at the forward PE, meaning that the expected earnings over the next 12 months, you look at the price multiplied by this forward earnings, right? The ratio currently is at 37 times. So again, 37 times, is it high or low? It's hard to say that this is like super cheap because you are paying $37 of price to get $1 of earnings. Okay, I'm not saying that it is cheap. If you are saying that it is very expensive because the price already went up by 200%, I also don't think so, because 37x PE, right, is not a super high numbers because share price went up, fundamentals went up. So all this I think is like the logical explanations. It's not like the share price continue to go up where the fundamentals remain the same. There are companies that's like that, you know, where the share price move up a lot faster as compared to their fundamentals, but not the case for Nvidia here. If you look at the PEG, because the growth is still super high, so divided you get like about 1. Actually, I mean, the textbook understanding is that if it is below 1, it's actually not expensive. You just look at these numbers, don't over-interpret it. Because we don't know, like currently they're in high growth, right? We don't know how long can it sustain after, let's say, all the hyperscaler get enough, let's say their data center, would they actually reduce their capex? All these things we don't know. But if you're just purely looking at today's growth number versus their PE, right, it is not that expensive. Then in terms of their EPS, analysts estimate EPS growth for the next 5 years, right, it is at 37% per annum. If you recall this chart, I showed this chart for quite a number of other companies, right? Actually, quite a number of big techs, they are around 5 to 10%. But for Nvidia, because the revenue is still growing, the margin is still maintaining, they don't have to lower the price to attract more buyers. So that's why all this net income, all these fundamentals numbers will still continue to go up. Hence, a decent 37% expected EPS growth for the next 5 years. You guys must be interested with the DCF, right? So I think DCF I have shared, this is the 3rd time already based on my record of all this DCF exercise. So the last time when I did this, right, was the data up to 2024 Q1, which was 2 quarters ago. So fast forward 2 quarters, I think it makes sense to just, you know, refresh the number and then just to see how much has the DCF or the intrinsic value went up since my last update now. The numbers here, I've updated the current revenue numbers. I also updated the growth expectations. But for the base case, right, actually I refer a lot to the analyst estimate now. So you know that when all these companies, they have more expectations on their future growth, right, they will try to communicate that to the investment community. And then all these analysts, right, they will actually put all this expected growth rate into their model. From that model, they will project what's the future revenue. So if you look at this revenue number here, for the base one, this is something close to the analyst estimate. But we want to see not just the base, right? We want to see the bear and bull scenario, right? So for bear and bull scenario, I will adjust their margin For Bear, I just make a flat 40%, although right now I think their margin is around 55%. For Boo, I just increase it slightly. But the main difference between the Bear and Boo is actually the growth rate. As you can see here, growth, I think overall the analyst is expecting still a very decent growth over the next 12 months. 54% growth, and then subsequently it will come down to 20%, 60%, and so on. Something that is in line with the market consensus. Then the Bear and Boo, I just plug in some number here to say that okay, if it is lower or higher, how it will look like in terms of their revenue trajectory, and then from the margin and revenue, we can calculate the operating income, and then from there we can just do some discounted cash flow and do an intrinsic calculations. For the discounted rate, I'm just using a flat 10% to keep it simple. I haven't changed that. Exit multiple also, I just put 20, 30, 40 for Bear, base, and Boo scenario. These are my numbers here. So the base or the new fair values, right, is $134. It is slightly lower as compared to the current share price, but it is not like super overvalued. So this is assuming that their growth trajectory that I'm showing here, right, will play out. But if it didn't play out, the growth is lower than expected, let's say something close to Bear scenario here turned out to be true, right, then we're talking about a fair values of only $55. So you need to remember that you invest in these companies, you are betting on all this growth number, you're betting on the margins will materialize. If all these things fail to materialize, right, current share price versus their intrinsic value is just like one third only. So you are taking some risk there, and specifically you are taking the margin and growth risk here. So if you want to compare versus my DCF 6 months ago, right, this is a comparison. So the bottom one is the same that I have shown. The upper one is the last update. So last update, I mentioned that the intrinsic value is about close to $100. Now it's already boosts up to $134 just because the revenue has bumped up. Margin is quite stable. I think mainly it's because their revenue base is higher now. Okay, so this is the numbers. You can pause here just to, if you are interested to understand how I derive all these numbers. All right, then just quickly looking at their breakdown of their revenue, you can see that their revenue, although some people may still think that Nvidia is a gaming company, yes, gaming still contribute about 3 billion of revenue in one quarter, but the bulk of their revenue actually come from data center business, which is currently close to 31 billion already. It is quite clear in this chart here. And then in terms of their financial statements, right, you look at their data center is the biggest one, and if you look at their gross profit, is still very thick. In terms of their operating profit, is still very thick. So this company is really have a high margin business, and this just shows that their moat is super strong and they have pricing power when it comes to selling their product. The customers still want to buy their products even though it is not cheap. So I mean, that's why I invest in these companies. It's not like because the share price go up, I just write the share price, right? I'm not a trader here, right? So I invested in this company since 2020. So I think we need to focus on the business, focus on their core products. Right now is data center, and follow their fundamentals. So that's my approach when it comes to investing. All right, I think that's all about the sharing on Nvidia. Hope you enjoy all these informations.